Great. So that's a bit intro. So financial reporting, planning and analysis. So financial reporting, planning and what? Analysis. Great. So that is the subject and that's the paper before us. Now, the objective of this paper, we will see it the next few minutes. But before I start financial reporting, I would like to explain accounting and then the stages in accounting for you so that you will appreciate this subject very well, especially for non-accounting students. Some of us are new to accounting. This is our first time hearing accounting. Yes, don't worry at all. Yes, right, right, please. Now, I'll write this on the board. It seems like you've heard it before. Financial accounting. Financial accounting. That's the first show. Second, we call it financial reporting. Financial reporting, that's what we are going to do. And then the last stage, we call it corporate reporting. ACCA, we call it what? Strategic business reporting. That's that paper is a strategic. Great. This is the levels of accounting. First of all, let me explain the word accounting. If you mention accounting, accounting simply means provision of information. Provision of what? Information. That's the basic meaning of accounting. We collecting data, analyzing it, and presenting it to what? Users for information, for decision making. So when someone is collecting what? Financial data, you are collecting financial data, analyzing it, grouping them, summarizing it, and presenting it to who? The intended users. What are you doing? You are accounting. So when your boss asks you, Madam Officer, or sir, in my absence, I traveled. I was away for some time. Come and then account for me what has happened. What will be the response? Your boss is just looking for information. What actually happened in his what? Absence. So you tell him, boss, when you went, day one, these are transactions. In summary, we spent this, we made this, and these are results. Great. So that is it. That is the accounting. Provision of what? Financial information. But there are stages, and there are so many types of accounting stages, especially the finance section. There are 3 stages, and you should know the requirement at each stage. If I want to talk accounting, accounting is very broad. The word accounting, but there are a lot of aspects of accounting. Can you give me one? The finance section. So you have financial accounting. Then we have what? We have the audits. Audit is part of accounting. We have what? The tax. Have you seen? Good. So all these form part of accounting. Yes. But that's not what we are going to do today, and that's not our agenda. Now, the stages in the financial accounting, the stages in accounting. First one, we did financial accounting. What's the meaning of financial accounting? All of you have heard it before. All of you must have done it before you were exempted. Yes. So financial accounting. Financial accounting simple. The objective of it are it simple means record keeping. So keeping of what? Records, set of records. So for record keeping. So let me write it here small. Records. Records what? Keeping. So if you say financial accounting, basically we're keeping a set of records representing what has what happened or transpired or the event. We're recording the event. We are doing what? financial accounting. We are done. Records. So at the basic level of accounting, we have to walk you through how to keep a basic set of accounts, how to record transactions in the financial books, how to post them. So that is the financial accounting. And that stage, all of us have passed that stage. Good. Then we go to financial reporting. Financial reporting, that's where we are now. Financial reporting, basically, in fact, you are reporting right on your financials, you are done. It means you are preparing and presenting financial statement, 2P coming together. Preparation and presentation of financial statement. So when anyone is preparing financial statement and presenting it, that person will do what? Reporting on the financial. So financial reporting, let me write it here. Simple means preparation. Preparation and presentation. Present it to the users, right? Presentation of financial statement, FS. That's great. So the preparation and the presentation of what? Financial statement. So when that person is preparing, the person do what? Reporting. So in short, it means that at the end of this paper or at the end of this program, you should be able to know how to prepare and present financial statements. Yes. If you have passed the paper and you cannot prepare a basic sort of financial statement, then you have to come back and come write the paper again. Oh. Yes. So that is it. So that's the objective. So the objective of the financial reporting, simple, to equip students on the preparation of basic set of financial statement. Basic set of what? Financial statement. Then we go to corporate reporting. The further, overall, the last aspect of financial reporting. The financial accounting. Corporate reporting, as the name suggests, corporate, the entire organization. So here you're reporting on 3 items. You're reporting on your financial, that's the profit. Reporting on your social justice, like the people, and then you are reporting on what? The environment. That's the environment, or the integrated reporting. So in short, the corporate reporting is an advanced form of the financial reporting. It includes the financial reporting itself. In fact, the corporate reporting talks about the entire organization. It includes the financial reporting itself and integrated reporting, IR. Integrated reporting basically explains how you add value to the organization. How do you create value for the shareholders? How do you make money for the shareholders? It must be in the report. And such a report is called corporate reporting, not a financial report. Financial report is just about the financial statement. I can give you a classical example. In the annual account of most companies, you see them writing chairman statements, directors reports, corporate governance stand, ethical issues. All these ones are what? Corporate reporting. They are the integrated reporting. And they will add that report to what? The financial report. And I believe strongly that some of you are preparing it. Some of you are in that capacity. You prepare financial statement for your organization and a report, director's report, manager's report, chairman's statement, corporate governance stand, ethical issues, environmental issues, green effects. All these will form part of the corporate reporting. I hope you get it. So in short, we know the subject that we are learning. So it means that we are learning this. We are here. We are here because we are chartered what? Bankers. Yes, we are chartered bankers. Let's call ourselves chartered bankers. But within some few minutes, they will pronounce it on us. So let's start. This one is for the chartered accountants. It's for the chartered accountants. So the chartered bankers, most students argue that as banking or as a banker, why do we need financial reporting? It's very important. It's very important. because normally nature of our work, you give advance to a customer and you advise the customer on some potential investment. Even before you give advance or a credit to a customer, you should analyze the customer's position. So the question is, if you don't know how to prepare financial statement, will you be able to interpret it or explain it? If the customer is wrong, how do you know? If the customer is lying, how do you know? If what they've calculated is not true, how do you know? So that's why we have to walk you through a basic, just a basic. It is not, in fact, your paper is not the same as how we test the chartered accountants. So it's a basic one. So that is it. So let's see the topics in it and what you should do, and then how your exam question will be set for you. How your exam question will be set. Great. Now, your subject is not just financial reporting or your paper. It's financial reporting, planning, and analysis. So 3 in 1, not just financial reporting. So you've added planning and analysis to it. So I'll do the topics. For these topics, I'm not the one, like they are not all stated in the syllabus. These are the likely or the most frequent asked questions. So first of all, under the financial reporting section, I'll write them in sections. So first topic that you should know is the conceptual framework, and that's what we'll be doing tonight. The conceptual framework. Conceptual framework of financial reporting. So we have conceptual framework and regulatory framework. So regulatory framework. It's basically a theory topic. Yeah, and it's a knowledge base. So this talks about the concepts and the rules and regulation guiding the financial statement. So conceptual and regulatory framework. So conceptual framework and regulatory framework of what financial reporting. So that's the first topic that we will do. Yes, that's the very first one. And such a topic, so theory. The last time that it came was October 2018. It came for 20 marks. It's a theory, so take note. Each and every topic may tell you the years that has been coming, and then the next time that is likely, the next likely ones. Great. So let me continue. Let me just trim some part of it, and then that's not good. Then the second one, we talk about the financial reporting standard. That's the next topic. Financial reporting standard. So out of the standards, basically 4 to 5 will be examined for 20 marks. 4 to 5 will be examined for 20 marks. Yes, and then it's a compulsory. Like, it's not like compulsory. Every sitting, it must be in the question, not like compulsory question. No. Just to demarcate a question as compulsory lies in the hands of the examiner. Yes, but financial reporting standard. That's the IFRS and the IAS. That's what most of the bankers don't like. Yes. Don't like it at all, but don't worry. You will like it. That's fine. So that's financial reporting standards. Then the third one is the preparation of the financial statement itself. That's the final account. So that will be preparation and presentation of financial statements. Preparation and presentation of what? Financial statements. That is the third one. Here you're going to prepare the final account. The final account. You know the board is not that clear. Great. Okay, let's see. I think it's a bit okay now. Now the financial statement that you're going to prepare, what are they? A. You'll be required to prepare the profit or loss or the comprehensive income. Comprehensive what? Income. Comprehensive income. B. You're also required to prepare changes in equity. Changes in what? Equity. 3. Also be required to prepare what? Statement of financial position. Yes. Commonly known as what? The balance sheet, right? So financial position. Great. The financial position. Then the D. The D is a cash flow. Cash flow. Cash flow statement. Now, this is a set. The first 3 is one set. So one set on its own. This one to another set on its own. So here, the preparation alone, they can get 2 sets of questions, 40 marks coming from there. Yes, that tells you that it forms the strategic or the core. You cannot write any paper, any financial reporting paper without the final account. It must be in it. Great. So that is it. Now, for the past 3 consecutive sittings, it has been this set, the first set, comprehensive income, change in equity, and financial position. So the next sitting is likely that cash flow may show up or say hi to us next sitting. So we should take notes. Good. So that's the third topic under the financial reporting. That's the third topic under the financial reporting. Then we go to the fourth one. The fourth one is interpretation of financial statements, as popularly known as what? Ratios. So we go to the interpretation of financial statements, popularly known as what? Ratios. Yes. That one too is also compulsory. We cannot, that's the analysis aspect. So you know that the statement is financial reporting, planning, and analysis, right? Great. Then this copy this part, let me continue I want to dash the board and continue the remaining one. The topics are many. Your topics are many. So it tells you that you have many things to cover before you finish the syllabus or before you write your exams. But there was good news. The good news is that we will finish. That's the good news. We will finish. That's the good news. Great. Let's go to the next section. You should know the topics ahead of you. And you cannot go and sit for the paper without this topic. No. So even if you are learning on your own, you know which topics are more relevant, are more like important than the other. Great. And you can also select, because your paper will be 7 questions and you answer 5. So that means there are 2 questions that you're going to walk away. So there are 2 of these topics you're going to walk away. That's great. So now let's continue the 4th and then 5th, 6th one, and you'll be fine. you'll be fine. Please don't forget to tell a friend to tell another friend. Invite friends. Yes. Now, the fifth one and the sixth one, I call them the ethics or the dynamic. Is it 6, 7? Going on the fourth one, I good. 5, 6, 7. The fifth one is called capital reduction or business reconstruction. Business what? Reconstruction. Reconstruction. And then the sixth one is what? Business valuation. Is what? The suspect, business valuation. And then the third one is the consolidation. Consolidation. Now these three are a bit stubborn one. They are a bit stubborn. Why are they stubborn? I'll tell you. You understand? Each of them add up to 20. All of them are full questions on their own. They are not sub questions, not. They are full questions on their own. Now the truth of the matter is that each and every sitting, maximum of 2. At least one must be there. One. At least one of these 3 must be present in your paper. At least what? 1. Maximum of what? 2. In fact, this has been the trend. This just range between these 2 guys. The first and then the second one. Just a second, let me. Now, the 3 consecutive sittings before they have brought the they brought the business reconstruction for 3 consecutive times. 3 consecutive times. Business reconstruction for 3 consecutive times. So that has been the trend. So I suggest strongly that the next setting, business valuation, will be the next. Because we also come in long. Great. So that now let's continue the game. So I hope you are looking at the topics. So those that you have to strategically answer them. So that's the financial reporting section. So financial reporting alone, you should know 7 topics. Wow. So for financial reporting alone, 7 solid topics. Then we go to the other section. The other section to have its own topics that you have to treat. So you realize that this paper is not like, even though it analyzes the basic concept, it's many. Yeah, the topics in it are what? Many. Yeah. Now let's move on. Then I'll go to the management section. So I'll continue the game. Then I'll go to the management section. The management. Management section, topic number 8 will be cost structure. Dealing with marginal and absorption constraint, break-even analysis. Yes. So all of them are in the same category. Cost structure, comma, marginal and absorption. They are in the same category. Cost structure, marginal costing, and absorption costing. Once they mention marginal costing, then they will do their thing, break-even analysis, like class own. Break-even analysis. So that's the chapter 8. Let's go to chapter 9. Chapter 9 is what? Chapter 9 is the budget. So there will be a question on budgets. Budget. So you call it budget and budgetary control. Most of your questions end at budgets, especially the calculation. That's where your questions end. Great. Then let's go to the 10th one. But the 10th one is another type of budget. The 10th one is not coming. So let me throw the camera a bit down. So let's see. Yeah. So I think we can see it now. So budgets. Okay. So 10 for one. Oh, this animal. 10 for one is investment appraiser. We also call it capital budget. It's a type of budget. So by its proper name is what? Investment appraiser. Wow. The last topic that almost every student answer it first, including us. Yes, we will do it first. Is the corporate governance. So that's the chapter 11. Corporate what? Governance. Corporate governance. That one, almost every student answer it. Nobody has done it before. Not at all. They will answer it. Why? Because purely theory or rating. Great. So it means that you have 11 topics to cover before you can pass this paper comfortably. But there are strategies. Some of them can be cancelled out, especially this one. Chapter 7 can be cancelled out. So 11 was 10. Great. Chapter 1 is not always that to be there. So 11 was 11, 9. So in all, you have 9 topics against 7 questions. So 9 important topics against 7 questions. So they will drop 7. Out of the 9 important topics, you are going to have what? Answer 5. So you can select your 5 now, or 3 of your 5 now, the compulsory ones. Then do justice to them. So this is the journey before us. This is the journey before us. And you must complete this before 15th of what? December. So that is it. We may do extra. Yes. May do extra. So if I have any question on the topics, suggestion, contribution, kindly let me know. Any question, kindly let me know. Yes. I hope everyone is with me. Hope everyone is with me. Yes. Okay, great, great. Good. So now we know our topic, right? Today we will start with the very first one, the conceptual and regulatory framework. And thank God that most of these topics, there are videos available, including the one that we are doing now. There are videos available to combat it. So all what you need to do is you going through them and you'll be fine. Please, I will tell you the sure way to pass this paper. There are 2 things that you have to know. The second one is more important. First, 2 things that you have to know. 2, if you want to pass this paper successfully, not a gentle pass, successful what? Pass. What you have to do is this. First of all, make sure that you understand the principles. So if you are learning conceptual framework, make sure that you understand every part of conceptual framework. That's the first one. Get the principle right. Get the principle the principles right. Good. Now, 2, solve enough questions, practice enough questions. This section is here. This section is not part of our game because normally we said that job has taken all our time. But can I show you that this paper is an intensive paper, and then you have already committed yourself, so you call it committed cost. Yes, you committed yourself. So once you committed yourself to do this, then why can't we devote time to practice enough questions to get it once and then for all, then we are done. So questions. So practice enough questions. In fact, if you have these 2, you are sure your pass is fully assured. And you'll be among those who smile. That's great. So I'm done and about to start our first section. But if you have any question, kindly let me know. Kindly let me know if you do have any question or challenge. Great. So you solving a lot of questions is more important. Now I have a quote that states that one known is not equal to one unknown. Wow. But 5 known. Wow. But 5 known is now equal to 1 unknown. Wow. What do I mean by this? This principle says that if you know how to solve one question under one topic, it's not enough. At least know how to solve it 5 questions or 5 different ways of doing the same thing. Why? This thing, 2 things happen. Let's assume that you solve 5 different questions under the same topic. So like the conceptual framework you're about to do, we solve 5 questions, different 5. When you go to the exam, 2 things will happen. Either one of the questions will be there, dito. But because we are writing professional exams, it's not likely that the question that you solve will be there, dito. No, this is not the degree. But the one that taught you is not the one setting the question. Great. So if you go and the question that you solve, none of them is there. 2 things. Either one of them will be there or none of them. Let's take the worst case scenario. None of the 5 questions drop. So the question that drop is unknown. You don't know the question. No idea. What do? The ideas of the 5, the assumptions of the 5, the understanding of the 5 will come together and kick the one unknown out of the way. You're able to sail through and get your gentle pass and then you move on. But if you have only one way of solving it, your mind will be too. The last time when I was doing it, I did that way, so this I'm going to do it this way or the other way. But over here, okay, the last time when it was that, I solved it that way. When it was the other form, I solved it that form. Now if it is this there, then let me do it this way. Have you seen? So practice of question is the key to professional success. No professional examination like you will pass without a practice. So take me. So this here, please, you can make it a plan. Each and every week I'm solving one question. Each and every week or every day one question. Before you go, I'll put a drop, questions, compared past questions. One day, one question. I'll start exactly 3 weeks from now. By then we've covered much, so I can put them. Now, if I start, I have no idea, so I have to wait until probably that 1 or 2, 3 topics. I'll start bringing them out. I call them drops. They are very good for your health. and then you'll be fine. Okay, so let me start the first agenda and then the topic of the day. We are going to do conceptual and regulatory framework. Conceptual and what? Regulatory framework of financial reporting. That's the very first topic. So let me start by saying conceptual. So conceptual and regulatory framework of financial reporting. Please, if you see me doing this, you know you can't meet in exams. No shortcut in exams. So please take note. Conceptual and regulatory framework of financial reporting. So basically, you know, each and every profession, each and every activity, definitely there will be some guidance, there will be some rules, there will be some principles govern that activity. So we'll call it concepts. Good. So in financial reporting too, we have our concepts. We have our principles, assumptions that guide the financial reporting. So conceptual. The conceptual framework is on its own. Then the regulatory framework is on its own. So I will start with the conceptual framework first of financial reporting. So conceptual framework of FR. Now, when you talk about conceptual framework of financial reporting, it simply means concepts, basis, principles, assumptions, phenomenon, practice that one must adhere to or form the basis of what financial reporting. So the concepts, the principles behind the preparation, the ideas, the practice that guides the preparation and the presentation of what financial statements. That is what conceptual framework of financial reporting. So the conceptual framework contains just principles, putting them together. That should form the basis. Yes, each and every activity that you undertake, there are principles, right? Yes. So some books write principles of life. In fact, there are some principles, there are some concepts guiding lives. Other institutions, marriages, constitution. In fact, Ghana, we have what? Our constitution, right? Giving us principles, giving us guidance, rules, regulations. Exactly. In financial reporting too, we can't just stand up and say we are preparing financial statement. No, not at all. I'm preparing financial statement, so I start prepare. Then I present it to the users. No, not at all. There are some basic principles that you have to familiarize yourself before you start the preparation. Other than that, your financial statement will have no use. So that is it. Now, this conceptual framework, it was given to us by a group of experienced professional bodies. Now, they are called IASB, International Accounting Standard Board. In fact, they put the concepts together. So sometimes we refer the conceptual framework as IASB's conceptual framework. So IASB's what? Conceptual framework, because they got it right by way of what? Citation. Great, we are giving reference to the owner. They put the principle together. Yes, because they have experience. They be experienced both practical field and then the knowledge field. So they put this experience and this practice together to form the principles. So anywhere you stand to mention financial reporting, you have to give reference, or you have to make sure that the concepts are at good position. That is the conceptual framework. Now, the ISB, but their main responsibility or their main role that they perform is to prepare and issue the IFRSs. What's the meaning of IFRSs? Now, it's the financial reporting standards. There are some standards that govern the accounting, the financial report that we prepare. Those standards, the main body, which is solely, is only one person or only one body which are permitted or allowed to prepare and issue the financial reporting standard. That is the ISB. Now, they prepare and issue the IFRSs. So the IFRSs are the standards that we are going to talk about. Now, why do you think they waste their time, their energy to bring this conceptual framework into being? Why do you think they waste their time? So what's the purpose of the conceptual framework? Why is it that, oh, they should leave us? Let's prepare a financial statement. Whatever you understand, put it on the paper. Yeah, you just to understand. But they say no. Let us have a principle, well-organized principles, structure, concept to form the basis. So what do you think will be the objective? Now, the objective for the conceptual framework can be grouped into two. We group the objective into what? Two. Now, the first part of the objective is to assess the board himself. I mean, this guy. Oh yeah, to assess themselves. They brought a conceptual framework to help them develop what their standards, their IFRSs. So it means that they tap on the principles stated in the conceptual framework to build an accounting rule called accounting standard or IFRSs. Great. So I normally refer the conceptual framework as what grammar in the house. It's full of knowledge and full of principles. You know, our grammars are full of what knowledge and full of what practical experience, unlike the young ones coming. Yes. So that is it. So the first purpose that we will talk about, but before I continue, please, I will upload the document on the platform for you and then the remaining ones. So you download them and then you do justice to it. You start the reading of it. Great. Now, the first purpose is to assist the board. So that's one, to assist the IASB in two ways. One, it assists them to develop what? Financial reporting standard. So financial reporting standard. Financial reporting standard. It's like anywhere you start to mention financial reporting or you are giving rule for financial reporting, if you are giving rule for financial reporting, you should be able to understand the conceptual framework so that you won't go astray. That's great. Let me do this. So to develop the accounting standard or accounting standards, we need what? We need the conceptual framework. So the board prepares and issues the financial reporting standards, and this must be built on the concepts and the principles stated in where the conceptual framework. Great. And then 2, the same board. So I is to assist the board to promote international harmonization. So the conceptual framework helped the board to promote international harmonization. Now, the issue is this. When the board set the IFRS or the financial reporting standards, we have to make sure that a lot of people or a lot of states, a lot of institutions, a lot of countries adopt the IFRS or the standards. Because I believe strongly that business, whatever you do, is not for you. Like, if you produce something, you need customers to come and patronage the goods. The same way the board, when they produce the IFRS, they cannot use all of them by themselves. No, they have to sell the good news of the standards so that a lot of countries will adopt it. So that's what I mean by what? International harmonization. The standard must be harmonized all over the world. And to do this, the conceptual framework limits the alternative treatment, so which help a lot of countries to adopt their IFRSs. I hope you get it. It helps countries to do what? Adopt their IFRSs. So that is it. So that's the second point, to promote what? International harmonization. So to promote, it assists the board to promote international harmonization of the financial reporting standards. International harmonization. Then let's go to the 2. It's also assist other people. So these 2 purposes are towards what? They are towards the board. We have other users. Let's list them. Other users. Give me examples of other users. Users of financial information. Oh, sorry. I want to write the second point on top. Sorry. Point 2. There are other users. What are they? The other users. So you have something like users. Users of accounting information. Something like auditors. Some people like, national standard setters. National standard setters. Sorry, national standard setters. National standard setters. Sorry. I think the what is not so national standard setters. Each and every country have what? Each and every country have standard setting body. And then this one is auditors. Auditors, great. Now, the issue is that these people, they need a conceptual framework. They need what? The conceptual framework. We can also include these people, the preparers, if I need it more so. The preparers, those who prepare the financial statement. So the conceptual framework serves as a purpose to all these other users. The first purpose is to the board. Second is to these people. Users, help them to what? Understand their financial statement and to be able to what? Interpret it. So for users, if they've submitted financial statement to me and then I don't understand the financial statement, I cannot interpret it. I have to pause. go to the conceptual framework, familiar myself with the concept and principles stipulated in there, then I'll come back and come and interpret it. So in a way, their principle will help users to be able to what? Interpret the financial statement. Because if you have invested money or funds in any company and they've submitted annual report or account you and you don't understand, you will be able to interpret it and make decisions out of the financial statement presented. Great. So that is it. What about auditors? The non-uniform police people. Police that don't wear uniform. Auditors, eh? Great. Now, for they are not police. They are not the police. Yes. I think I'll work on that. Yep. Okay. Now, auditors. With auditors, all what they need to know, they want to certify themselves and to be sure that the accounts are true and fair. So they are just in to make sure that the right thing has been done, that's all. And then to form their audit opinion. So they are there to check whether how you have prepared the account, that is how you're supposed to prepare it, according to what? The relevant rules. You obey all the relevant rules. And one of the rules is the conceptual framework. So it means that if there's no conceptual framework, auditors will find it difficult to judge and see whether you've done it right or wrong. That's why we normally state that where there's no law, there's no crime. Instead of law, if someone go against it, then the person has committed a crime. Where there's no law, then no crime. So for auditor, it will help them to form their audit opinion. It assists auditors to form what? Their audit opinion. Great. National standard setters or setting body. Each and every country have their national accounting standard setters. Yes, they will set the standard for the nation. Normally, they depend highly on the international form or the ACIB conceptual framework. The ACIB conceptual framework set as a what? As a guide. It helps the national setters to build upon their local standards. Great. Preparers, consultants, directors who prepare the financial statement. How will the conceptual framework help them? It assists them to prepare the financial statement. Great. We are done with the purpose of the conceptual framework. If you have any questions, kindly ask, and then we move on. Great. Please make sure that you get every aspect of this, and you will be fine. You will be fine. If you have any question, feel free to ask the question. Just show your reactions. What are they? Either you give me hands or a thumb or just laugh. And I have a question. Or do this, I understand, and then probably unmute your microphone to ask all the questions that you want to ask. That's great. That's great. Okay. Now, we know the purpose of the conceptual framework. Can we also analyze some few challenges that we have with the conceptual framework? Few challenges that we have with the conceptual framework. So let's see the limitations of the conceptual framework. The limitations of the conceptual framework. Conceptual framework. The limitations. or the challenge of the conceptual framework, the challenge that we have with the conceptual framework. The principles that they put together, what do you think will be the challenge or the issues that will come with it? If they are giving us principles that should guide how the account should be prepared, how the account should be interpreted, what do you think will be the challenge of these principles? For the conceptual framework, I call it the principle bank. You know, we have question bank again. Principle bank. So in code, that's what I call it. The principle bank. Accounting principles. That's where, okay, so that's fine. That's fine. Now let's see the challenge. Now the users of financial statement, that's the users of financial information, or the users of a company's records. There are many. There are a lot of users. Users are many, right? There are varieties of users. All of them have a different need. Let's give an example. Owner of a company. What the owner needs is different from what the employee also wants. Employee, what they want is what? Their fat salaries and annual bonus. Regularly pay to them on time. Make sure that you don't sack them. Give them flexible time to go in school and come back. Meanwhile, if you go in school and come back, owner too will lose you. Push you, do your work for you as you are at school. Great. Now, and management team. Management. What about loan creditors? Loan creditors, those who have given loan to the company. But the users are many. There are a lot of users, including customers, employees, investors, shareholders, which is the same as the owners. They have a different need. What they want are not the same. Their needs are not the same. So why should one set of principles guide all this, be of use for all this? The same principle that they use to prepare the account, the same principle they use to understand it. Meanwhile, the understanding of the preparer and then the understanding of the user, usually they are not the same. Yes. So it means that their conceptual framework only provide a general knowledge. It does not provide specific needs of a user. I get it. It does not provide a specific need of the user. It's a general principles that we are giving. It does not provide a specific principle to a particular. We don't have conceptual framework for owners. If you're owner, you have to read this conceptual framework. That one is for only owner. If you're employee, read this one. That one is only for employees. No, we don't have something like that. All the conceptual frameworks one. So it means that it does not provide specific need of the user because there are varieties of users. Great, I'm done with the first point. It does not provide specific needs of the user of the users. So it does not provide a specific need of a user. Two. What can we say? Two. Now you realize that the principles that they are giving us, sometimes when transactions become complex and then the business grows and we expand, we have a lot of branches, we operate in a lot of countries. Our risk level has been expanded. So it means that the old principle can no longer apply. The old principle can no longer apply. So that means that when transactions become complex, or when complexity set in, the old principle can no longer apply. Formerly, we were like this. Can the principle that govern when we were like this operating just some part of Accra? But now we are in the whole Ghana. Everywhere we did there. Everywhere you go, we are there. Everywhere you go. Can the principle that we adopted here also govern us here? No. Some of them might not be applicable. Why? Because now transactions are what? Complex. They are complex. So the old principle can no longer govern us. Great. Now let me give you a real life example. I have one real life example that I always give. So let me also say it. Let's assume that when, not even assumption, it's a real life example, so there's no assumption. When everyone is young, probably you are the one that doing most of your house chores, probably washing dishes for your mom, your parents, yes, or if not, doing some of the stuff for your mom. Now, when you probably get married and then one day you decide to pay your mom or your parents a visit, upon arrival, can they ask you to probably go to the kitchen, watch the boat before you come and talk to them? They can't, eh? Why? Whilst you have your younger children, or there are some people that they can do. Why? Because now your transaction is what? It's complex. So the old principle can no longer what? Apply. So that old principle falls short. Let me give you another one. Let's assume that in the house, if you inform everybody, all the children, that as soon as you eat, after eating, please wash your bowls. Nobody should leave any bowl unwashed. And there's one children that he's not feeling well. You are the one that fed that children. He can't even walk. So after feeding him, do you expect to go and then stand up and go and pick the bowl and then wash it? Meanwhile, it is a principle in the house that when you finish eating, you have to wash the bowl. No, he can't. So what do? So it means that now that situation is what? A bit complex. So the old principle can no longer apply. So that is the point that we are talking here. I am done with what? With the challenges with the conceptual framework. So we are done. Now I'm done with the intro of the conceptual framework. From here going, I'll move a bit faster. Now let's tackle the content of the conceptual framework. Now the content of the conceptual framework. The conceptual framework is just like a document like this, which contains pamphlet or booklet, which contains the principles. All the principles are laid down. Everything is inside. So we are going to look at the contents. Some of the few principles stated in what? In the concept. Some of the few principles stated in the concept. So that is it. Now, the content number one, you don't need to know the content. All you have to know is the issues in the content. You don't need to know the page number. It's not necessary. You don't need to know the chapter 1, chapter 2, chapter 2, what is there. It's not necessary. This is not a project work. No. All what you have to do is what is in there. If you can remember that, there was even a topic in it called objective of financial statement. That's all. It's enough. And you know everything about it is enough. Good. So content number one. So the content of the conceptual framework. Content number one talks about the objective of financial statements. So the question is, why do people prepare financial statements? Who can tell me? Why do entities prepare financial statements? Companies preparing financial statements. Why do companies prepare financial statements? Any idea? Any idea? Yes. You are allowed to respond to it. If you want to respond to it, just show a reaction. I will unmute your microphone, then you come in. Why do business prepare financial statement? Now, the main objective is this: not to publicly tell profit, not to publicly tell the cash that they have, not to publicly display the asset that they have. No, not to show off the liability that they've incurred or they have. No, not to show anything. The financial statements are prepared in circumstances where ownership and management are in different hands. The financial statements are prepared basically to provide information. So the main objective of the financial statement is to provide information. To provide what? Information. I'm done. So we are not there to like boost or show the asset that we have. We have the most expensive asset, so which we are happy to prepare financial statement to show that asset in our books. No. You know that sometimes ownership, this is the owner, Mr. A, and form a company. It's not the one managing it. Yes, the company is in a different town. In fact, the company is in the same town, but it's not the one managing it. This is the company. And he has entrusted the management, the day-to-day running of the company, in some group of people called the management team. So management team is running the company for him. You don't know what's going on there. So they will have to furnish information to the owner. Not only the owner, maybe the customer, general public, the government, the loan creditors, other investors. So they have to tell them information about the company. How we get it? So where ownership and management are in different hands, then management have to convey or provide information to the users. How we get it? Great. I like that. I like the point given for reconciliation purposes. Okay, I'll take that. I will take that. Just that, but the idea is there. Idea is the reconciliation. Now, Makola woman does not prepare financial statement, but she can tell you all her profits. Yes, they don't prepare financial statement. They can tell you the profit they've made. They can tell even the number of times they've gone on market for the year. Why is that they don't prepare financial statement? Because he's the same person owning the business, the same person managing the business. So if he can deceive anybody on this earth, not himself or herself. So where ownership and management are different hands, financial statement information must be provided. Yes, because if you set up any business and you are not there, always want them to tell you information. Sometimes you are somewhere and you are monitoring your business. You are calling, what happened? Yes, have you signed the document? Oh yes, I've signed. Okay, for this one. Sometimes all the accounting transactions, the financial sections pass through your eyes. But still, some of the information they have to provide it to you. So that is it. Great. So now that we know that the main aim of preparing the financial statement is to provide information. So the question is, what type of information are you going to prepare? Tell me the type of information you're going to prepare or the kind of information you're going to send to the users. Are you going to carry all the books from January to December, all the records, scan all the receipts, all the soft copy, and go and dump it on their desk, or go and dump it, or go and publish it? Not at all. You can't do that. So you can't send all the information. So we have to provide some specific information, the relevant ones. One, provide information about one, your performance. Tell us, provide information about your what? Your performance. Which of the financial statements are you going to analyze your performance? Is the profit and loss or the comprehensive income? P or L? But the P&L. Yes, I will say we should call it what, profit or loss. So if we're asking profit or loss in short, what do you call it? It will be P and L or P or L. Exactly. Great. So the performance, your performance, and your profit will show your performance. Then 2, tell us information about changes in equity. Changes in equity. Tell the owners whether their capital has changed. From January to December, transaction and event has occurred. Will it affect the equity or the equity is stunted? Then 3, tell us our financial position. Financial position. Then 4, tell us our cash flow position. Cash flow position. Cash flow position. That's the cash movement. So basically, this is a final account. Yeah, so this is a final account, basically. So these are the information that you are going to tell the users. These are the information you are going to provide to the users. You are going to tell them our performance. We tell them our changes, effect on our equity, our position, and then our cash flow. Great. Now we know this. How many times do we have to provide such information to them? So the question is, how many times do you have to prepare financial statements? How many times do you have to send this information? Please, the people financial reporting, we should know how to prepare financial statement. But before we prepare, we have to prepare ourselves. Set out the basis, the concept, the environment. We have to prepare ourselves for it. So all this will help us when we start the actual financial statement preparation. So we know the rules govern. And you know why you are preparing the financial statement. You are preparing to show what or to provide information to the users. Then how many times do you have to prepare the financial statement? Is it every day? Every day? Or every weekend? Or every month? Who can tell me? Every day? If I have any idea, you can type it. Every day, every weekend, every year, every month, or every 5 years, or every 6 months. I like that. I like your answer. Yes, at least once a year. I like the answer. At least. In fact, that's what the standard is saying. And then the company's code. Annually. At least twice a year. I like that. At least 2 times. So the least one must be 2. I like the answers. But the answers are so fantastic. At least twice a year. In fact, annually. At least once a year. Perfect. In fact, the financial statement must be prepared at least once a year. At least once what? A year. At least once a year. So if I've not prepared it at all, not once a year, the annual one, it means that you are able to prepare. You can prepare 1, 2, 3, 4, 5, 6, 7, 10, 20, 52, 365. That means every day you prepare financial statement. Don't forget that the more you prepare, the more cost you incur. So to be in business, after getting all the money and you put the money into the financial statement preparation, don't forget that when you publish the financial statement, you buy stand in the newspapers, right? It will cost you extensively. The accounting department will sometimes tell that we need a software. Our software for financial preparation has breakdown. Let's update the software. So anytime updating the software, every time we are buying this for the preparation. Great. So most company prepare 4 times in a year. For such a company, they play a smart game. They only publish one. Auditors, in fact, I've not even mentioned auditors. If you prepare 10 times, auditors have to come around 10 times, come audit them. Even when they are coming around once a year, once a year. Auditing is once a year. Look how much they are charging you. They're taking from your profits. And now they are coming like 3 times. And now you are just working for them. It's like you're working for them. You gather money when they come and then take it away. Great. Now, most companies prepare 4 times. The 4 times, the last one, the annual one, they prepare in quarters, quarter 1, quarter 2, quarter 3, and then the final one. However, they only publish the final one in the newspapers, and then the quarters reports are uploaded on their website, because that one is not expensive to upload the quarterly report on your website. Most of the companies do not even publish the quarter report at all. It's for internal managerial purposes, for internal assessment and appraisal purposes. So at the end of the day, they will publish at least one of the financial statements must be published, audited and published. At least must be what? Audited and published. So that is it. So at least you have to prepare what? Once a year. So if you don't prepare quarterly or monthly or 6 half yearly twice, if they wait at the end of the year, prepare. Auditors have to audit it and then publish it. You are done, and the cycle continues. So that is it. Great. So now we know why we are preparing the financial statements, so that when we start preparing it, we won't be confused about the item. Now we know how many times we should prepare it. We can prepare like as many as possible, just that the cost involved. So because of the cost involved, most companies prepare just 1, 2, or 3, maximum 4. That's it. But most of the banks bring out reports, weekly reports, so that one is called financial statement. Great. Now we mentioned the users of financial information. I'll list them on the board. What are the users? That financial statement that we have prepared, who are the people who are going to use it? If we call them stakeholders. So the stakeholders, they are the people that they have interest in organization, or the organization's activity affect them directly or indirectly. So any body or any person or institution that the company's activity or actions affect directly or indirectly, such a person is what? A stakeholder, or you are a user. They are 1, owners, shareholders, or investors. These 3 people are the same thing to me. 2, management team. 3, employees. 4, customers. 5, suppliers. 6, loan creditors. Loan what? Creditors. Or usually the bankers. Right, bankers here. Or lenders. Those who have given, I like that. Customer, government, shareholder. I like that. I like that. Answers are great. So let's bring the government here. Yes, as when you mention the government, you can say government and its agencies, or the government agencies, such as what? The government authorities or agencies. Such as GRA, right? The tax authority. They are interested in what? Tax authority, Ghana Tourism Authority, Ghana Standard Authority, EPA, Environmental Protection Agency. All of them, they are also interested in your financial statement. And then lastly, the last person on the list, the general public, you're also interested. So these are the users of the accounting information, general public. They are also interested in your. So these are the users. Now, if you pick each user, you should know their information needs. These ones are basic. These ones are for financial accounting. So it's a recap that we are doing. All these are stipulated in what? In the conceptual framework. It will tell us who we should prepare the financial statement to. So owners, what are they looking for? Owners are looking for 3 items. If you are the owner, and they prepare financial statement of your company and they've submitted it to you, what do you think will be the first thing you check if you're the owner of that company? So owner, you owe the company a loan and they prepare the financial statement, they presented it to you. What are you going to look at it first? Profit. First thing you check is profit then. Yes, I'll check the profitability first. What about the second item that you check? After you checking profit, don't forget that the company is what? Is distinct from its owners. So even if they made 10 billions of profit, it's not yours. So, so after profit, you check. But if they make 10 billion profit, it's not yours. For the company, it's not for the owner. The company and owners are different. They are distinct. Dividend. I like that. In fact, yes. So first, you check for your profit, whether the company have made profit or is profitable. Second, you check for your return on investment. The return on investment is the dividend. Are they going to pay me dividend? Because they are managing. Dividend, shareholders, you can't pay yourself dividend. Dividend is in the hands of the directors. So if they made a profit, have they declared dividend, I'll go and check first so that I'll be happy. At least when there's a profit, it gives me some hope that indeed dividend can be what? Declared or paid to us. Apart from that, what do you check again? In fact, you check so many things, but the first three is what we are looking for. The very first one that you check apart from any other item. So first you check for the profit, the returns, and then finally, you check for the viability of your investment. Assuming that you started the company alone, some company that I know, they started at Cocoa Bay in one single room like this. Now this company is having a factory, a giant ultramodern factory at industrial area, North Industrial Area, Tema. So if you're owner of such a company, you look at it, you consider, oh, I started operating as a sole sourcing, but now I'm operating in a lot of countries. So they see my investment as what variable, as what expanded. You consider that. Other than that, if you started 20 years ago, you are still where they are still making thousands of this profit. Meanwhile, all the companies that you started with now, they've been expanded. They are still at where they are. What do? You plan of exit. Either you sell the company or put up and go look for different things to do. Because you can't be investing money where every time seed must grow and germinate and grow. It has germinated and it's not static. So you look for a different fertile or profitable investment to do. Great. So that is it. What about management team? Management. Those that manage the day-to-day activities. Well, they're also interested in profit, even though it's not yours, it's not their own. They're interested in profits to know the overall performance of the organization because they are entrusted in the day-to-day running of the organization. Yeah, that's management. So that they can make the economic decisions. What about employees? Yes, they are employees. Employees. This one, everybody will tell me, what do you want? When the company where you are working in, when you get the financial statement, what's the first thing you check on the financial statement? Which is your interest, though. Don't go and consider somebody's interest. Oh, I was going to check someone's interest. No, check your own interest. So that's when they presented financial statement to you. What do you think you go? I open to that page and go and check. You check profit. Would they give you some? Would they give you some of the profit? I like that. Salary increment. That's the first thing you check. Bonus. I like that. So first thing that I will check, are they going to increase the pay next year? That's the first thing that I will check. Are they going to pay us the bonus? Because they said that if we achieve 10% profit, they'll give us bonus. So where is the bonus? Are they going to pay it to us? So the first thing is increase in wages and salary. That's the first thing that you check. Second, before they will think of what job security. You have to second think of job security. Am I going to be sacked next year? Are they going to announce redundancy next year? Are they going to probably declare some a pay cut next year? Employee turnover, great. Are they going to declare that next year? So that's the second thing I'll check. Job security and good working condition. In fact, some people, once the money is enough, they don't care about the working condition. If you like, put them in non-AC room. Let the room be hot. So they work. If you can give them their 50,000 plus a month, they're okay with it. They're okay with it. So it's in order. First, you check the increment in salary, job security, and then you consider the working environment, the condition, the job condition. Just that the job security sometimes depend on the profit of the company. Ideally, a profitable company will be in business for long. So for that one, it's not always the ideal situation to probably announce redundancy. If the company is making loss consistently, that's where I think of, okay, let's lay off some of the staff so that we can make some good profit for our people. That is it. So you can use the profit to assess the continuity of the entity. Great. What about customers? Yes, customers. We are customers. You buy products. Yes. You buy products. Customers, what they need. Customers. You buy products. Customers, what do you think will be their need? What are they looking for? When they pick your financial statement, what are they interested in? Your customers, what are they interested in? Business continuity. Is that the first thing they will check? They don't check that too. Because some of them know that if you collapse, some people come and provide it too. High return on investments, customers. Okay, I get you. Customers, I get you. Customers. Now the customers, they are not like the investors, especially the bankers. Customers are not like the investors. Customers are the people that buys your products, your service. Maybe you are running service, e-switch, money transfer. People that partner the money transfer, they are your customers, not the shareholders, not the owners of the bank. Good. Credit availability. Customers of a company. Let's take any company apart from a banking company. Then I'll bring it to the banking sector. Let's take a company like, yes, Gin Water. Have you seen this one? This is Gin Water. And water produced by what? Ghana. It's produced in Ghana by Ghana Water Company. Okay, Ghana Water. So Gin Water. Great. So I'm a customer. So when they prepare their financial statement, assuming this is a financial statement, what do you think will be the first thing I have to check in the financial statement? Because I always consume their water. I like consuming awake engine water, something with that make, and then black one. Yes. Because I'm not making an advert for them for teaching purposes. Great. I'll check the profitability. Oh, but will they come and give me some? No, the profits. I have to check something that will benefit me, not something that will benefit them. If they are making profit, if they are not making profit and they are giving my water, safe water to drink, why not? I'll take it and drink it. Their profit is going to solve their own profit issue. So what will I check on their profit statement? I'll first of all check whether I'll check for the quality of the water and at what reasonable prices. Are they going to increase the price of the bottled water next year so that I'll make my plans and switch quickly? Quality, are they going to reduce the quality, the pH of the water? Are they going to reduce it next year? Are they going to reduce the volume of the water, the size of the water? Are they going to make it eco-friendly? Are they going to reduce the price, or are they going to increase the price? So customers are interested in what? Quality product at affordable or reasonable prices. That is it. Even if the company make billions of profit, they'll not give me some Gin Water. If I buy all their water that they produce and make billions of money out of my pocket, they'll not share with me. they are going to enjoy the profits because the company is not mine. Good. But what I'm interested in is that they'll be able to give me quality water to drink at reasonable price. The price must be like, let's say, 1 cedi or 1 cedi 20 pesos. Not like 2 cedi or 3 cedi. I will not buy. Everything. Great. That's the first thing that I'll check. What again do you check? What again do you check? One, you check continuity. That's where the profit will come in. I'll check whether drink water. Maybe I have developed a strong taste for drink water. Some people, if not a particular product, they will not consume any product apart from a particular product. Those people, when the day that product will collapse, how will they survive? So if I have developed a strong taste for drink water, I will check whether they are going to be in business, their continuity, whether they will stay in business and produce my water for me. Now let's assume that they produce raw material for my production. Let's assume that I use their water to make my drink. I produce drink. So I use their water to make my drink to sell. When they collapse, I won't get water to produce my drink to sell. So it means that I will consider their continuity. When they collapse now, I may not be able to continue my business. I'll be get that. Great job. What again will I check? The last thing that I will check, some of the customers, they like companies that are socially responsible, company that they are loyal, company that they have a good moral character. People consume a lot of awake. Why? Because of 1 for life. Every 1 bottle, 1 pesewa is given to Kwelebu Kaido Center. Great. Such company, customers will read and see, oh, they are doing well. They are building schools for these people. Okay, then I'll buy their products. The next day they read your financial statement where you stop producing those social responsibilities. They will stop buying your products. Oh yes. I like drink water. Why? Because it's made in Ghana, of course. The next time that I see that drink water is not made in Ghana, it's made in any other country, I'll stop buying it. Everything great. So this is what I will consider. What about suppliers? Today I intend not to move fast. What about suppliers? Suppliers, let's assume that we are a company. We are a company. Okay, I promise you that I'll bring one banking example. Let's take any bank. Let's assume that you are a bank and your customer, maybe my bankers. I am a customer to them. Probably I deposit my funds there. I receive some of my transfers there. Make some of the payment on my behalf. So now I'm a customer to that bank. What do you think when I get their information? I will check it. First, I'll check what quality service at what affordable price. Yes. Let me give you a personal example. I'll give you a personal example. When I was in school, around 2014, thereabout there. Then there was a bank. I won't mention their name. Then I have an account with them. It's not student account, it's just savings account, where like they normally remit some funds, fees into that account. I take it and they used to pay my fees. And then students and having account, and then they loan me that I should come for a Visa card. I went for the card every month. They're taking 5 cedi from the account. Meanwhile, I'm not working. In fact, it's the fees. That account is proposed for fees, receiving my fees. So every month they are taking 5 cedi from that account. Every month 5 cedi. So I realized that no. So it got to a point. So some points being it, but I realized that's vanished from the system. Not knowing they say they are using it. So I quickly asked them to publicly close what? The Visa card for me. But now I've asked them to reactivate it back because now they can deduct because the account is a bit active. So you said it right. So when I receive, are you going to provide reliable service, fast service? Some of the bank people don't like it because their service are not fast, slow, queue. I don't want to mention. You know yourself. I don't want to mention. Queue. Some of them too fast. paperless transactions easily. So all these customers will check. Customers will read the information to know whether you provide or you can be able to provide what? Reliable. That's a quality service at affordable price. Yes, at affordable price. Oh, affordable. So that is it. There are some people every day they are giving us debit alert, not credit alert. Every day debit alert. Dear customer, your account has been debited this amount. This there service charge fee. Have you seen? Great job. So that is it. Now let's go to suppliers. Suppliers are the people that give us the raw material. Let's assume that we are a cake manufacturer or we are pastry. We manufacture pastry or we bake pastries. What are raw materials? Flour, margarine, and then the other ingredients. So those that supply those flours to us are suppliers. Taking bank, for example, those that supply the services, the IT softwares, those that supply the checkbooks, the cards, those that run some of your services for you. Most of your security services are on supply. It's not in-house security service. So all these ones are suppliers. What do you think would they need? What do you think would they need? Tell me, a supplier. Someone that supply a service to you. What do you think would the person need? What do you think would the person need? Someone that supply service to you. They've supplied book stationery, your notebooks, your printouts, your t-shirts, your stationery, your furnitures, your softwares. Some of them can even supply staff. Oh yes, they supply staff. What do you think would they need? Any idea? Anyone who help me? Business continuity. Oh yes, that one day, yes, it's a key, it's a factor. Yeah, because that's where they have their daily bread. Have you seen? That's where they have their good. I like that one. In fact, I like that one. I like that one. I like that one. In fact, somebody have mentioned something that I like it. Yes, I like that one. I like that one. Great. I like that one. That answer is super fantastic. Now for suppliers, the first thing that you check is what? You check. If assume that you supply some goods to some company and they prepare financial statements, first thing that I will check is what? The ability of the company to pay for the goods supplied on time. The company's ability to repay a debt. Yes. As and when they fall due. So ability of the company to pay a debt, the short-term debt, suppliers is short-term. Short-term. So the ability of the company to settle their short-term debt as and when they fall due. Or the credit worthiness. That's the first thing that I will check. In fact, even if the company is making consistent losses, but when they buy from you, they pay. Oh, why not? I'll sell to that company. Than those that make huge profits, but they will delay the payment. I'll be get that. Great. Then after checking whether you can pay my money back or whether you can pay me as and when the need arise, then the second thing I will check is that I will keep track or I'll check whether you can be or you can keep within the terms and then the other conditions or the terms of supply. Some company will tell you, okay, if I supply you with your raw material, with the flour that you need, please don't buy flour from anywhere. Buy it from us. Yes, buy from us. And when you're buying from us, use your company name so that we can know. That's the terms. Today you are buying from it, the next you are buying from someone. Now when the raw material becomes scarce and then you are now running to me that I supply to your own supply to you. So whether it's in abundance supply, still buy from us. Whether our price is expensive or not, still buy from us. That's the terms and conditions. So if that customer or if that company can abide by our terms, we will supply him. And the last thing that I will check is the continuity. Are they going to be in business? Because Sometimes they are my major customer. They account for a larger percentage of my sales. When I prepare, they buy more of my goods for me. So when they're in the business, I am business. When they lose, I'm gone. Like COVID. Have you seen some of the business, they're supposed not to collapse. They're supposed not to collapse. Some of the business, they're supposed not to collapse. But it's as a result of the collapse of one business leading to the other. Look at the COVID. How COVID had destroyed some company and destroyed the other. Most of the employees are home. Just not because they can't work home. Because COVID has rendered their employers, no job. So for instance, taking schools, markers, those that mark examination papers. Exams are not being conducted. So what are you going to mark? What are you going to mark? Teachers, what are you going to teach? School are not in section. Textbooks, photocopy printers, printing presses. What are you going to print? School are not in the section. No examinations, no test. So when you are in a business, I'm in business. So the last that I'll check is what the continuity. Great. That is it. Then I am done. The remaining ones, with the help of what we've done, you can be able to explain them very well. If you have any question, you can ask. Loan creditors. Suppliers the short term, loan creditors the long term. Loan creditors, they will consider or they will check whether you can pay back their loan on time. Or you can also keep within the interest. Because some company, when they pick loan from you, after paying the principal, the interest, they forget it. The interest, forget it. They won't pay the interest. Child. They'll change their company name right now. Or they run away from the country. By the time they come back, they come and form a different company. You will even notice them. That's the company. Then the government agencies, especially tax authorities, what are they interested in? One, they're interested in your profit so that they can determine what? Your tax liability. What about EPA, Environmental Protection Agency? They want to know whether you are complying with environmental laws. Ghana Tourism Authority, we want to know whether you are complying with the tourism regulations or tourism act. 1% levy, are you paying it? Every company. In fact, even if your house, visitors come there, your house, you start as a recreational center, you have to pay 1% to Ghana Tourism. So when you pay that account, you have to see whether you showed that thing, whether you paid or not. Agreed. What about general public? You want to know whether you are not causing harm to the environment or you are going to probably giving back to the society, corporate social responsibility, building of rules, schools, and making the environment safe for living, especially for those in the extractive industry. Those in the extractive industry, you are done. Okay, now let's continue. Now I'm done with the first content. I think much the time has been set here. I like that. Okay. Now let's continue again. Let's go to the content number 2. So now we know the objective of the financial statement. We know the users. We know why we prepare financial statement. And we know who we are preparing the financial statement to. And we know what their needs are or what they are interested in, so that we can provide it basically for it. Content number 2 talks about the underlying assumptions. Underlining assumptions. But what the assumption? Why call it assumption? 1, going concern. Going concern. That's the underlying assumption. Going concern. Now it's a very topical issue. Auditors like using it. So today let us be auditors for today. Okay, today we are auditors. So we are going to use it. Going concern. Because they're supposed to assess the going concern of an entity before they issue their audit opinion. Now, there are so many accounting concepts or accounting assumptions. At the level 1, you came across about 20. There are many accounting concepts. What are they? You can mention them. Accrual, going concern, money measurement, prudence, consistency, fair presentation, dual, all of them. But there are some of them, or there are two of them that it has been underlined. I mean, saying it has been accepted, it has been linked. That is the main assumption that we should use. That is the backbone, like that's the basis. So even though there are other assumptions, the one that they have what underlined, the one that they have what accepted that it should be the main central focus for the preparation, the main one is the going concern. The main one is what? The going concern. So we should understand the going concern. What does the going concern mean? The going concern simple means the entity or the company, will continue its operation for more than one accounting year. That's not going concern. You are not going to collapse now. Future is unknown. You live to see tomorrow. You live to see tomorrow, next. You are not going to collapse now. So it means that as an accountant or as a director, as a consultant, preparing the financial statement, make sure that put at the back of your mind that the company will survive into the next 12 months, or the company will survive in its operation for the next 12 months. That's the going concern. Now it means that the company will continue its operations, will be in existence or operational existence for the foreseeable future. For foreseeable future. It means that they are not going to collapse now. That's a simple meaning. They are not going to collapse now. Yes. So it means that carry all the balances and push it forward to the next year because you live to see tomorrow. So it's because of going concern. That's why we have balance, closing balance. Close the balance. Closing what? Balance. And the technical term is called balance carry down or balance carry forward. Carry forward, right? It's because of going concern. Because you know that you live to see tomorrow. So don't worry. If you know that tomorrow you are going to be in Accra. Oh, and then when you cook plenty food, you don't need to worry because tomorrow you'll be in Accra to continue enjoying the food. But if you know that you are leaving Accra tonight, you cook and leave some in the fridge and travel? Not at all. I won't do that. Even if I'm going and come, let's say a week or two, I won't even do that. I'll be getting great. And the same way we have the open balance. The open word balance, which is also known as, the term is called balance word brought down or balance brought forward. Agreed. Brought down or brought forward because of going concern. But if you know that you don't live to see tomorrow, your future is in doubt or your going concern is in doubt. When somebody says that thing to you, the person has insulted you massively. Because that your going concern is in doubt. You don't know whether you're going to live tomorrow or not. It's like all hope is gone. Oh. Like all hope is gone. That's the actual meaning. Great. So that is it. However, the ball won't fall down. Oh. Sorry. However, if you know that future is known to you, tomorrow, you don't live to see tomorrow. You are going to probably, the business will be halted. Then do not use going concern. Oh, I'm just writing it again. Then do not use what? Going concern. Now use the other one. Use the breakup basis. Break up what? Basis. Now the going concern basis means that you live to see tomorrow. If you know reasonably that you are going to collapse within the next 12 months, then please, the last financial statement that you are preparing, do not use going concern. Instead, use what? Breakup basis. Why? Because you don't live to see tomorrow. You're going to collapse. So don't not use going concern. How we get that? Use what we call the breakup basis. Great. People, entity know that they're going to collapse. Yes. Let me give you, we have the good section and then the bad section. Good section. You set up the company for 5 years to deal with some issue. And now we are in the 5th year. So the last financial statement, that's what they're preparing. So that one use the breakup basis. Yes, that most of the collapse of the companies are not in good condition. It's sudden, nobody knows. Just one wake up, they declare bankrupt, and then the company is gone. That is it. Okay. Now the next one I'll talk about it is accrual. Accrual. Accrual concept or accrual basis. These are the two assumptions. Accrual basis. Accrual basis. Most of you are familiar with it. Now, this one states that transactions and events must be recorded as and when they occur, but not when cash has been received or what paid. The transactions and events must be recorded or must be recognized. Must be what? Recorded or recognized. Recognized as and when they occur. As and when they what? As and when they occur. They occur. As and when they occur, but not when cash is moved or cash is being paid or received. Cash is what is being paid or received. How we get it? Let me end it there. So long as the transaction is okay, please record it in your book. Don't wait till you receive the cash. How we get it? Great. So that is it. So because of that, I have a formula. Yes, for it. The formula is very simple. It says that record or recognized. Record is equal to occurrence. So once the transaction has occurred, please record it, irrespective of the cash involved. So let me give you an example. During 2010, the company made a sale of 50,000 cedis. Out of the 15,000 cedis, 40,000 were made through cash. So the cash component is 40,000. Credit component, the credit sales is 10,000. Now tell me, how should the company treat this? Should the company record sales of 40,000 or sales of 10,000 or sales of 50,000? Which is which? The company should record sales of 10,000, right? Or 40,000 or the 50,000 or 90,000 or 100,000. The company should record sales of what? Any idea? Chai, some people are sleeping. No. Hey. Some people are sleeping. No. Yay. Don't worry, close to them. There's some few minutes. Okay. So here, according to the Accrual concept, they record a sales of what? 50,000. The entire sales must be recorded as what? Sales. Why? Because during the year, 50,000 occurred, not 40,000, not 10,000. So the total transaction or the actual transaction that took place must be recorded. However, if some part has not been received or paid, like here, 10,000 has not been received, then we have to accrue that one forward. You have to what? Accrue it. Accrue simple means set it for future. So like they'll come and pay it for the next period. That is the accrual concept. Good. It opposes, the accrual opposes the cash basis. So the other ones I was writing, I wrote the first one, the second one is the cash basis. So the cash basis is the direct opposite of for the accrual. For that one, you record transaction as and when cash is being paid or received, not when the transaction occurs. So the transaction can occur in 1960, but if the cash will be effected in 2020, wait, record it in 2020 books, not 1960. That's the cash basis. So in the example that I give, we record only 40,000, even though the sales was what? 50,000. We record only 40 as sales. The 10,000 will not be recorded until it is being received. Then we record it. We are done. Now in exams, when they ask you to explain the underlying assumption, when they need one, is a going concern. Why? In fact, the truth of the matter is that the underlying assumption is only one. But the truth is one, right? Great. This accrual is all part of going concern. Out of the belly of what? Going concern flows accrual basis. What do you mean by that? Tell me, if you don't live to see tomorrow, will you still need credit? Will you sell on credit today? If you know that you're going to collapse, your business is coming to an end the next 3 days, will you give credit for 5 days? Not at all. Even 3 days don't even give. So it means that companies that do not have a going concern, they don't normally apply the accrual concept. So the accrual concept is inbuilt in the going concern. So in that case, it makes the going concern the underlying assumption in the preparation. So it means that the financial statement that we are going to prepare, both exams, in reality, we have to assume that the company will be a going concern, except otherwise stated. Great. I'm done with the underlying assumption. I'm done with the underlying assumption. On that note, I'll pause here for question solving, for questions. So if you have any question, you can ask. For today, we'll close exactly 8:20. So we have barely 4 minutes to finish. Let me wrap up with the next topic. We will start it and complete our next meeting. Great. So the next assumption is the next content. The next content that we need to know is the qualitative. Is the qualitative features of financial statement. Qualitative features. Qualitative characteristics of financial statement. Qualitative what? Characteristics of financial statement. Of financial statement. Sorry, since that today the body is suffering from performance, to be fine. Now, I won't finish this today. No, we finish it the next meeting. So you'll be fine. We'll finish this the next meeting. Now, the financial statement that we are going to prepare, both in exams and in practice, it must possess some features, some attributes, some qualities. It must exhibit some key symptoms. If it be a coronavirus, we tell you that the key symptoms is what? Coughing and sneezing. and code. So now they say because of COVID, there's no common code. All code are not common again. Could you imagine that since the inception of the COVID, I have no cough. It wouldn't even come. We have to stop you somewhere. And then I wait to cough right now. To pronounce it on you. Yes. Great. So what are the key features, qualitative features? In fact, the features of financial statement that we are going to prepare, there are two. There are two types of the qualities, or there are two types of, let's say, the features. There are two types of the characteristics. We have the quantitative features and qualitative features. Have you seen the two? Quantitative, quantify, monitoring. So quantitative and qualitative. Most books, what we learn is the qualitative. We don't ask for the quantitative, but it's there. Quantitative are the monetary amount, the calculation, the amount, the profit itself, the currency, the gross profit. These are the quantitative, the figures, the numbers. Great. But here we are going to look at the attributes, the key features that it must possess. I'll just look at the two for today. Now, the features, they are grouped into two categories. Some of the features are called A, fundamental. So they are what? Fundamental qualitative characteristics of financial statements. And some of the features are also called enhancing. Wow. Enhancing. Just that the fundamental are two. Under the fundamental, we have two. We have only two. Under the enhancing, we have four. So two fundamental, four enhancing. Why do we say some of the features are fundamental? Fundamental features or the characteristics are those attributes or qualities that make the financial statement useful. So any feature that make the financial statement what? Useful. Make it meaningful. Make the financial statement authentic. Make it great. Make it fulfill its intended purpose. That feature is what? Is fundamental. Is the root. Every financial statement, very good one, must have it. Yes, very good financial statement must have what? The fundamental. Great. Then we have the enhancing. For the fundamental, there are two. Let me just list them. Today I will not explain them. So your holiday assignment is that you are going to explain them well. So the next time we meet, you are going to lecture one after the other. I can see. I have scanned. I've taken screenshots of everyone in class today so that next week I won't hear a story like I wasn't part. I wasn't there. Not at all. I've started my game. The fundamental, there are two in number. One, we have what you call faithful representation. Faithful representation. It means that the financial statement must be faithfully represented before it can be useful. Two, it must be relevant. The financial statement must be shaky. It must be relevant. And then the B, we have the enhancing. Enhance, I normally say they are the features that bright. They normally like bright, add a little value to it. Or like the fundamental, they like make the financial statement like great. So that is it. So the enhancing are four in number. One, they are comparability. All of this, I'm not going to explain them. Yeah, your homework in advance. Explain the following. Homework number 1, you're explaining faithful representation. Tell me everything about it. Homework number 2, tell me relevant, the meaning of relevant. It's supposed to be relevant, so it's not relevant. It must be relevant. Good. Then comparability. Then the second one is verifiability. I like that one, Pound. Verifiability. Understandability. Oh, the it, yeah. Understandability. Is it coming? Yes, it's coming. Just that today, about understandability. And the last one is timeliness. The financial statement must be on time. Timeliness. So, it's moving further. It's moving further. It's moving further. Good. Oh, this is not coming. So the last one is what? Timeliness. Please add it to it. Timeliness. Financial statement must be prepared on time. I'm done. So please, that's the homework in advance. You are providing the meaning to this. What's their meaning? Provide understanding, because next week when we meet, I will take them. And then next week we'll try and see if we can finish the first chapter. So I will run. For the intro, they have to run. When I go to some place, I'll probably slow down a little. So on that note, this is how far the good Lord will bring us. Yes. So thank you very much for coming. If you have any question, kindly ask.